Good afternoon and welcome to a new virtual investment summit by Fund Society. In times where interest rates are at historical lows and the stock market is at historical highs, we're going to bring the bull and the bear face to face to search for the best ways to invest. To help with this discussion, we are welcoming two portfolio managers from Thornburg Investment Management. Founded in 1982, Thornburg Investment Management is a privately owned global investment firm that offers a range of multi-strategy solutions for institutions and financial advisors. A recognized leader in fixed income, equity, and alternative investing, the firm oversees $47 billion as of March 31st, 2021, across mutual funds, institutional accounts, separate accounts for high net worth investors, and UCITS funds for non-US investors. Thornburg is headquartered in beautiful Santa Fe, New Mexico, with additional offices in London, Hong Kong, and Shanghai. As you will see throughout the panel, Thornburg believes that unconstrained investing leads to better outcomes. Their investment solutions are highly active, high conviction, and benchmark agnostic. Before we start, I would like to remind you that after the panel, there will be a Q&A session open to the public. You may post your questions in English or in Spanish throughout the Q&A button at the bottom of the screen in your WebEx event app, or by emailing your questions to info@fundsociety.com. And now, let me introduce our panelists and moderator. Our bull for today, defending the equity side, is Miguel Oleaga. Miguel is a portfolio manager of the Global Opportunities 40 Act and UCITS Fund, and also manages the Institutional Global Opportunities Strategy and Global Quality Dividend Strategy. He joined Thornburg in the year 2014 and has been working as portfolio manager for the firm since 2017. Before this, he worked 10 years in the investment management industry as an analyst. And on the bear side, defending fixed income, we have Lon Erickson. Lon is portfolio manager for the UCITS Limited Term Income Fund and the Strategic Income Fund. He also manages several fixed income institutional strategies and 40 Act funds. Lon joined Thornburg in 2008 and was made portfolio manager in 2010. Previously, he worked over 11 years in the financial industry as an analyst. He is a CFA charter holder. And to conduct the friendly battle between bull and bear, we have the pleasure to welcome in our studio Alejandro de Lara, an aerospace engineer who nevertheless has been working in the financial services industry from 2004. From 2014 onwards in Insignio, based in Miami, where he currently is product manager for the advisory business. Welcome, Alejandro.
Thank you.
So go ahead, please.
So Lon, Miguel, pleasure having this conversation with you guys today. To begin with the conversation, I was told that actually the conversation was going to be on equity versus fixed income. Quite a challenge, right? And so the first question that I have for you guys is, if I were a portfolio manager and I am managing a 50-50 portfolio, and I am in the need of doing a tactical shift, should I tilt towards fixed income and to what segments? And that question goes to you, Lon.
Sure, and you're right, it's a very difficult question given the general low prevailing rates, particularly in developed markets. I think what you have to consider is the broad way in which fixed income can help an individual's portfolio. Certainly it's one of those asset classes where you're looking for protection, against some of those riskier assets such as stocks. And what we're really looking for is that, despite the fact that we've talked that there's low income throughout many sectors, income still exists. But what you have to think about is, again, that portfolio being that ballast for investor portfolios, that will generate income. There's still income. If you take a 10-year US bond, and we were looking at a bunch of them just this morning, and you add something like 100 to 150 basis points, you're getting, nothing that is out of this world, but you're still getting 2 to 3%. And that's something in this marketplace. And depending on your CPI basket or your PCE basket, which I want to say, there's a real return there. but it's also that preservation of income, so that it can play a role in, if we get some inflation, you see credit spreads tighten, which is beneficial. And if you get a sell-off, then the risk-free rate part of that proposition in a lot of high-grade bonds is that you would find a very nice cushion that would provide to your portfolio. So, when I think about that question, we could argue, last year before pre-COVID, we were in a very similar situation. And, I don't think we're going to get another COVID-like drawdown, but, I think you can expect continued volatility. And I think your fixed income, a variety of sorts can provide cushion. And you're looking, across, so you can look at asset backs, there's corporate opportunities, there's EM opportunities, current foreign currency and US dollar, as well as, just pure sovereigns. And I think you just have to be willing to do the work. It's not where you're just going to spray your portfolio with anything. You really need to have the willingness and ability to kind of take that deep dive and pick individual securities that will help you meet that goal of both some income and some protection.
Got it. Perfect. And Miguel, now, going, on with the same line of thought, you hear a lot of strategists talking nowadays that, look, fixed income is overpriced, interest rates are very low, the equity risk premium is it tilts towards the equity side. Tell us a little bit of what you think. Again, thinking of this 50-50 portfolio and having to carry out a tactical shift right now.
Sure. So when we think about kind of the way the markets have evolved over the last 18 months to 2 years or so, there has been a pocket of the market that has really increased in value. And so that's mainly in North America, especially around technology firms. A number of those firms did quite well last year in the early days of the COVID crisis. But when we take a step back and look at a broader picture, and especially when you have a mandate like we have in the Thornburg Global Opportunity Strategy, where we can be global and we can go across all different market cap sizes, there are still very kind of attractive and compelling values out there. So if we zero in on North America and the US, outside of maybe some of the more darling software as a service type names or kind of internet names, which are well liked by the market, despite the pullback that we've seen in those names this year, we still think there's a lot of interesting names that are reasonably priced and attractive even within technology. But when we go further and we look at other parts of the U.S. economy, especially the more cyclically exposed parts of the economy, those tend to look more attractive, even despite the run-up they've had in the first 5 months of this year. Zooming out then and looking across the globe, the prospects are still compelling. The way the economy, global economy is reopening around COVID, it's certainly much more phased. And markets like the US are maybe doing better with the adoption of vaccines and the ability to normalize. But there are a lot of economies that are still being very much impacted by COVID. And that results often in the equity prices of some market leaders in those countries, in those economies, just not representing their true worth. So we can see that in places like India and emerging markets. We tend to believe that there's still very attractive opportunities. But even if we go to more developed land, international markets like Europe and the UK, we're still seeing those equities be undervalued relative to what their earnings power should be, just given the way the COVID crisis has dragged on it in some of those markets. So for us, we're still finding really good opportunities. We're tilted more to the ex-US than the US, but we still think there's a lot of pockets of investable ideas out there from an equity standpoint, and the overvaluation really is more focused on a subsegment of the US market, which we're still finding ideas around those.
So you would tell me, or you would advise me to increase two equities in this fictitious 50-50 portfolio?
Well, I think every investor has to make sure they have they have a portfolio that makes sense for for their respective needs and the goals they're trying to accomplish for sure. But I think I would say that I'm still very much bullish the prospects that exist on the equity side. Here in the U.S. For example, given the stimulus that's been put into place and the investments that are being made coming from the government from a fiscal standpoint, that's really helping a large part of the economy kind of get back on its feet and in very many ways maybe get back on its feet in a more efficient and better way than before we went into the crisis. And you're starting to see that similarly outside the U.S. as well, where if you look at a market like the U.K., they made large stimulus support for the end markets. Interest rates are favorable. They're getting relatively high vaccination rates out there, and I think that sets up an environment where their economy gets back on its feet, and the animal spirits and the bullish spirits of entrepreneurs and investors gets going again, and those economies have and those markets have a long way to run before they really get back to being fully in overvalued over the medium to long term.
Perfect. Lon, where are you seeing attractive opportunities in the fixed income space? For example, do you like leverage loans? Is that a space in which, nowadays you see, with interest rates, in theory, going up, inflation, is that one space which you would find attractive? And which other? I'd like to hear your thoughts on this.
Sure. I think there's a few, and I'll answer I'll talk to the leverage loan space to begin with. And I think you're right. There are attractive aspects, but what I think investors have to remember first and foremost is that leverage loans are just that, leveraged loans to highly leveraged company. So they're basically a high yield product. They just happen to be floating rate versus a fixed rate bond. And so I think if you go into that product just thinking, hey, this is an interest rate protection vehicle, you might be severely disappointed when the market turns, especially given where spreads have gone. Now, that's not to say they don't have a place. We do use them in what our products that have that mandate. So something like our UCITS strategic product, we certainly have that capability. And when it makes sense, we do. But we look at it on the credit. We're evaluating the credit metrics, the fundamentals, not just saying, hey, this is floating rate, let's just buy it. We're going to look up and down the capital structure. Usually those are senior secured. And then we look at the bonds and say, where is the most intelligent place to be, the best risk reward, best relative value to participate? And sometimes that isn't in loans. And I think given where spreads are, maybe on the margin, loans are a little bit more attractive than bonds. But again, this is a one-by-one evaluation because we build those portfolios brick by brick. The other place in particular that we really like is investing behind the consumer, particularly the U.S. consumer. Miguel talked about the stimulus that has come into the market from the government, also is from the Fed. And what we have seen is that the behavior has been one that U.S. consumers have been very prudent with their debt usage, but also repaying the debt that they have taken out. They were in a good place pre-COVID, and they're back to a pretty good place between the stimulus as well as job reopenings. And we do invest in that via a lot of asset-backed securities, consumer loans, auto loans, and the like, as well as the in different parts of the non-agency mortgage market, because one, it's a consumer loan, but then also you have housing behind it, and the housing valuations are actually are strong. Underwriting is still pretty good. And so we have been investing up and down the capital structure. Something for UCITS LTI, which is more high quality, we're staying more up in the senior tranches. But something for UCITS strategic, where it has broader acceptance of lower, we can invest in the subordinated bonds, and we can invest in some of the residual pieces that give us things that are very attractive, low double-digit returns to high double-digit returns, depending on what type of assumptions you make. And so that's what I was talking about before. What we like about the mandates we have is it gives us a lot of flexibility to go, where the value is, and when there's not when the risk isn't priced attractively, like it's a lot in corporates and especially in high grade. So in UCITS, this LTI, we are being a little bit more defensive. We're trying to be a little bit more conservative, just because we don't think we're getting paid to take a lot of risk. That's rate and credit. but so that's we're being shorter. Where then there's a few more options. We also think very selectively for the reasons Miguel said. There are some very differing experiences with COVID, but that does internationally. But there does create some areas that we do like, where especially for EM countries that have strong export economies, because they're not as reliant then as having the domestic demand to because their COVID has really shut them down, that they're not reopening as fast as the U.S. And then some with real high interest, with real high real rates, something like Egypt or the like, it has some interesting real rate local bond opportunities. And so those are the things that maybe I would point out. And then I would say it's just on the corporate side, still opportunities very selective, high yield, spreads are tight, but there's some interesting yield to call paper that we're being involved in.
Perfect. Thank you for that. I'm a wealth manager in the end, and I do deal with private clients. And so you come up with situations in which private clients say, I can be the stock picker. And Lon, in your particular case, you're talking about mortgage-backed securities, agency or non-agency, leverage loans, all these sophisticated instruments for the majority of investors that are very difficult to access outside of a mutual fund wrapper. In your case, Miguel, if you were to come in front of one of these clients who thinks that he can become an individual stock picker, and it is true that buying individual stocks is easier than buying into mortgage-backed securities and what's not, what would you have to tell to them?
Sure, certainly. So I think there's a value in terms of investing through kind of a wealth manager as yourself, or through a mutual fund product, or a strategy like a UCITS that we can offer. I think one of the keys that stands out is, yes, we can zero in on any one individual stock and kind of consider it may look attractive because it's cheap on its metrics and such. But I do think as more and more investors, particularly retail investors, start entering the market, those opportunities become harder to come by and represent true value. So in our strategy, we have a value orientation, but we're much more focused on intrinsic value. And there's a complexity there that makes it much harder to do than I think just looking at whether or not it's on a low price to earnings ratio or low kind of EV/EBITDA multiple, et cetera. And so that requires the resources of going deeper, being able to understand kind of where a company sits in its industry map, understand the value chain for that entire company and industry, and whether or not that business has competitive moats. And so when we take a step back and we look at the way the markets have evolved over the last few years and really over the last decade, some of the best bargains never were optically cheap. If you look at some of the tech names in North America that had done really, really well, they never looked cheap. But if you really had the resources to go deep and to understand the fundamental drivers around the business and why that company was positioned better than most, you would see that it still was a bargain on an intrinsic value basis. And so I think as a retail investor, that's one of the things you have to consider. Are you well equipped to be able to perform those kind of analysis and to be able to dig deep and get those insights around the industry and around the competitive positioning of that company, versus just coming in and either buying something because it's optically cheap on a low multiple, or because it has a lot of buzz around it in social media or in other platforms. And I think this year in particular, we've seen the pain that side of it can cause, where there have been a number of names that have been very well liked and garner a lot of media attention, but they've really pulled back. So the U.S. tech and growth basket, is off anywhere from 20 to 50% in some cases, and having the ability and having the resources to determine whether or not that's just a kind of a transitory pullback and a great buying opportunity, or a permanent impairment of capital, in my opinion, kind of requires having a good team around you to be able to really make those assessments. Fortunately for us, we do have a central research platform, with 10 plus analysts helping us kind of weed through these key questions and kind of zero in on the critical variables around each and every investment idea, when it's both a prospective idea and when it's something that's held and maybe not working at that point in time in our strategy.
Perfect. Let's get back to the value versus growth discussion in a minute. But before that, I had a question to you both on capital market expectations, right? Because again, when you look at what in general the market is expecting for equity returns, we see the typical range of 6 to 7%. For 10-year expectations, which somewhat has remained unchanged, even though we know that the picture for 2020, 2019, and 2021 has been very different. But in any case, that 6 to 7% with volatilities, standard deviations that could be up there in the 20s, or in the high teens. And when you compare against the fixed income, in which in spaces like emerging markets or high yield, you can get a solid 3 to 4 with considerably lower volatilities. The question here is there anything, or is there such thing as investing in equity for cautious investors or for conservative investors? Because again, you hear analysts saying, oh, you should shift towards equity because bonds are overpriced. But equities are very volatile, right? And even when you look at hedge equity strategies, and some people out there are selling you hedge equity strategies, like if they were a proxy to fixed income. I'd like to hear your thoughts on this. Is really equity a proxy or a substitute to fixed income? And perhaps we can start with you, Lon.
Yeah, my answer, and maybe I'm talking my own book, would be no. In the sense that I think you hit the nail on the head. Is that even with some of the higher volatility asset classes, and you named them, in high yield and leveraged loans, I'd put there as well, depending on the market, and emerging markets as well, local and U.S. dollar, is the role of fixed income, is to be that lower volatility product in your portfolio. And I think there's two ways to think about it. In the high quality portfolios, I think you're typically looking for something that has low correlation with or negative with riskier assets such as stocks. So in our UCITS limited term income product, what we're trying to achieve is something that will be very low correlated, so that when stocks go down, we either stay flat or maybe go down a little bit, just directionally. But when you have something with a little bit more risk characteristics, such as a UCITS strategic product that has that broader mandate, while we can dial back risk, it's going to be something that has lower beta, so it may go in the same direction as stocks, but you're looking for something that has a little bit or a lot less, volatility to the movements in stocks. But what I think you have to remember is that there are different flavors of this, and ours is, and the way you think about risk management and how you think about positioning the portfolio for those potential drawdowns, and we're very cognizant of that. I think our general strategy has been to outperform significantly on the downside when there's drawdown and participate in the upside, and that's whether it's in the limited term income or in the strategic income variety of the UCITS product. And you do that through a heavily diversified portfolio, because in fixed income you have very asymmetric type returns. You can either get your coupon back, or your coupon and plus your money back, or something significantly less, potentially zero, which, the zero is the same downside that a stock potentially has, but stocks have a lot more potential upside in there. So but you need to get paid for it. And that's, I think, the primary consideration that I think individuals need to have is, how is a manager positioning it? How do they think about risk, and how do they think about pricing that risk? And when do they take it, and when do they don't? Are they willing to back down? Do they stay true to that solution? We got to always remember that these are fixed income products. We're not looking to be an equity substitute from our side. We're not trying to hit home runs with fixing a product. Particularly when we're in an environment like this where rates are low and credit spreads are low, tight. And so we're trying to hit singles and maybe some doubles occasionally. And if we're lucky, sometimes we can invest in convertible bonds that does give us some upside into that looks more like stocks. And sometimes we can maybe get a triple and maybe a home run, but that's not really the point. It's really about being an income driver and being that, ballast, for the portfolio, being that lower risk component, no matter what segment we are talking about, whether it's a limited term, high quality, or strategic, multi-sector that's a little bit more broad.
Miguel, your thoughts on this?
Yeah, thank you. If I can add to kind of Lon's points, I think it's very valid. Equities are not going to be a substitute for fixed income products in terms of the volatility or the diversification benefits they do add to a portfolio. But for a investor who maybe is willing to accept the higher volatility and the higher risk that comes from investing in equities for income, I do think now is a relatively attractive time for that. And so if we look back historically, on a very long track record, 80, 100 years for the market, typically, the equity income is a significant part of the overall market return, except for the last decade or so. It's been a very unique period in which most of the return in the markets have come from capital appreciation. In many ways, that is driving investors to kind of shun higher dividend payers in the marketplace. So when we look at it today, there are a number of companies that are, they're very well positioned in terms of the cash flow that they generate and the ability to kind of meet and pay their dividends. But uniquely, in somewhat kind of a COVID twist, a number of these companies, out of conservatism, did either scale back or outright cut their dividends last year to ensure that they had sufficient cash flow and maintained a very strong balance sheet in a very uncertain time. So there are a number of names where the dividends are just being reinitiated and restarted, and oftentimes it's happening at a much lower level than in the past. And so for fundamental kind of bottoms-up equity investors like us, one of the catalysts that we can capture is the ability to go find these names that, from a coverage standpoint, can afford their dividend, and particularly the ability to maybe even restore that to historical levels, and benefit as those distributions start to come back. And in many ways, I think that can ultimately complement some of the yield loss that we're getting from rate compression that we've seen on the fixed income side, though that may come with bouts of more volatility in the asset, the underlying asset relative to a bond for sure. But overall, I still think the opportunities are attractive for equity income seeking investors.
Got it. Perfect. Going back to the conversation about fixed income, and then I want to jump into value versus growth, the ever ongoing discussion. Emerging market bonds, they're probably one of the best performing assets or subcategories within fixed income, but I don't see, I do feel that investors in the U.S. shy away from them. Do you guys shy away from emerging market bonds? And remember that this is a very offshore audience that you're talking to, that is very much into buying emerging market fixed income. Lon, that's for you.
Yeah. I wouldn't say we shy away from them. I would say recently we had, because we had been pulling back in risk, say pre-COVID, not because we were predicting a global pandemic, but just because we didn't think the values were there domestically or abroad in what had been getting to be a long in the tooth growth expansion. And so we were just looking to play a little bit of defense. And so that led us to go to the US, buy a little bit more treasuries, a little bit more higher quality, generally be shorter. But now, as we are seeing that reopening that's been mentioned a few times, we are looking for additional opportunities for growth in terms of where sovereigns can see better current account and budget situations, as well as individual companies look to be improving their cash flow profiles. And as I mentioned before, it's very bifurcated, and maybe a smaller number of opportunities that we're looking at right now, mostly because of the COVID situation that maybe is hampering reopening in a domestic sense. So we are looking for those external exporters that are seeing some benefits, that's benefiting their current accounts and maybe having a better growth impact on their economies, which will support not only the sovereign but also individual companies in those markets. I think historically we have been more favorable on companies' debt, where we can really get in and chew on the underlying fundamentals and understand the risks that are taken. Now, of course, that does bring into the operating territory that they're in and what the governments are setting up as far as rules of the game. But at least with companies, it's a little bit more straightforward. But there are certain sovereign opportunities. I mentioned Egypt, where we think it's interesting. We think they have some discipline around their financial situation and the rate situation, versus somewhere, let's say, like Brazil, that it's not only suffering from the COVID situation, but also from back and forth around political policies and what seem to be some more unstable government institutions, perhaps, or even then look at some of the countries that are having significant social unrest due to government attempts to kind of get more fiscally sound, whether that's in Chile or Colombia, and that's why it's, even with those, it's a you just can't go out and buy yield. I think that's one of the most dangerous things that we see all the time is, and we see it across markets, and it's not just EM, but it's in high yield, and it's in US as well as investment grade and across domestic markets, is people just see a big spread and chase the yield without real consideration of what the underlying fundamental situation is. Now, if you look at the default rates, you tend to get paid back, but when you put them in a portfolio, we're very concerned about what kind of ride you're going to get in a fixed income portfolio, and you have to consider that the volatility profile, and that needs to get compensated. And that's why right now we're slowly trying to dip our toe into some of these areas, and taking a look at some of the other ones harder. We have some, we bought some bonds out of Abu Dhabi today that look pretty interesting. Not the sovereign, but actually a company that's owned by the sovereign. So there's different ways to participate in that marketplace, and I think you just have to take it one by one and build a diversified portfolio. And that's what we try to do. We think we do think it's a good addition when you think about in terms of Sharpe ratios, or just simple concept of risk reward. We do think there are some good opportunities that blends nicely into a diversified portfolio.
Perfect. Miguel, and staying on the topic of emerging markets, what's your opinion on increasing exposure to emerging market equity within a portfolio?
Yeah, for us, we've selectively have become more bullish emerging markets, and given the prospects going forward from here. Now, clearly, the way COVID is impacting and the way COVID is essentially causing kind of a phased reopening across emerging markets is something that we consider. So we're more selective around the areas that we're going into. But we are finding some opportunities in places like China and in kind of emerging Asia broadly. So we feel that at the right size for a portfolio, the risk reward skew is definitely attractive to get into emerging markets. And I think what's interesting, especially given the lessons that we're able to kind of extrapolate from the US market, is that there are certain types of business models that have proven themselves out to be kind of long-term winners. And we can study those in a market like the US, but as we've talked about, and we'll continue to talk about kind of this growth versus value debate, the market has quickly realized that and has certainly priced that in. And those names tend to trade with very rich multiples here. But then if we look kind of across the globe, we can see that in a lot of these emerging economies, there are local operators who are trying to replicate these models. So, an example is, we think about e-commerce and what Amazon has been able to successfully do here in North America. Well, there's many companies that are starting to try to do that in emerging markets. And so in our portfolio in India, we own Reliance Industries, which is a conglomerate, but one of their fastest growing assets and one of their more valuable assets is trying to replicate similar kind of e-commerce initiative like Amazon that is kind of attuned to the needs of that particular marketplace. And we feel like we're getting a great value there because it still trades like the kind of like an energy company that is the main source of the cash flows today. But overall, though, we think the framework of thinking about why Amazon has been able to be so successful in a market like North America, if we apply it to a market like India, we can see a lot of those same attributes emerging very early on in that penetration phase and in that growth cycle phase. And so for us, we feel like we're getting good value on kind of a winning business model by looking for those business models in emerging markets. Clearly, when we do have some of these continued kind of flare-ups of COVID in markets, that does cause some concern for investors, and they step back from names that we think are great businesses and that should be able to endure the choppiness that COVID presents, and it allows us to use our longer kind of time frame to buy those businesses at better prices. So over the last year or so, we added Taiwan Semiconductor to our portfolio. It had a good recovery kind of in the second half of last year. But as we looked more recently, there's been some COVID cases flaring up in Taiwan, and investors have kind of de-risked, but it's been a great opportunity to kind of add back to that name. Similarly, with some of the Korean tech names that we own, we've done similar. So overall, we're positive emerging markets over the long run. I think clearly we've been very selective in terms of which countries we go into and in particular which industries where we invest behind. But we're positive emerging markets in the strategy, and it's kind of one of the larger ex-US areas that we're invested in today.
Perfect. Let's turn into the conversation of value versus growth, because I would like to dedicate a few minutes to that. For value investors, it's funny because they've had to humble down their tones, but it seems that redemption is in the stage of the cycle, right? In other words, everyone says that we are at the stage in which eventually value is going to pick up relative to growth. And that could be the case, but I've always wondered, is that a short-term scenario? And two, in a world where future growth predictions seem to matter more than valuations, and just look at Tesla as an example, right? Do you think we're really going to go back to the Graham type of investing philosophy in which value really matters? In other words, do you think value will ever outshine again?
Yeah, I think the key is how does one define value, right? And for us on the Thornburg Global Opportunity Strategy, we define value intrinsically. So we want to go and determine what a business is actually worth, and we want to buy it for less than that. Now, that business may be in the technology sector, where the growth of earnings over the medium term is what creates the underlying value of that business. Or it can be in a much more cyclical sector, like a U.S. bank, where during the height of the COVID crisis, the market has sold off the shares, and if we look at kind of mid-cycle earnings power or mid-cycle economics, that business is going to be worth a lot more. And so for us, our strategy and our view has been by thinking about what the intrinsic value is, it allows us to build more balance into the portfolio, where someone can be agnostic to where the value is coming from. Is it growth, or is it just like a statistical cheapness of the underlying asset today versus what it can be? I think looking broader in terms of the debate of how one defines growth versus value classically in the marketplace, to me, I think ultimately it comes down to do you fully understand what the business is, and do you fully understand what's happening underlying for the business? I think one of the areas where many kind of traditional value investors stubbed their toe on over the last, call it 10 or 15 years, is that by first leading in driving the analysis by looking at just a low multiple, that ignores a lot of the other stuff going on with the business. And the question really being is, are the go forward earnings and the go forward kind of competitive landscape for that business the same as it was in the past? And for a lot of these companies, we've come to realize is that the answer was no, it wasn't. And the market was kind of right in putting a low multiple on that business. And so I think really understanding kind of why the stock is cheap, what the concerns are, and can the business get back to earning the kind of returns that it has in the past are really critical and very essential. And I believe just assuming that there's just reversion to the mean because something is cheap today is risky from an investing and a portfolio construction standpoint. Similarly, if we look at the other end of that spectrum, there are some growth names that have very, very rich multiples, and the market seems to really buy into their story, at the very least on a conceptual level. But I think the reality is, if we take a step back and we think about many companies, whether that's like a Facebook, a Google, an Apple, et cetera, the market was very bullish on those names 10 years ago, and they were right to be bullish because they generated very consistent earnings growth. And if we were to fast forward 3, 5, 7, 10 years, they're very cheap on future earnings. And I think the market has kind of learned to appreciate and done a better job in terms of understanding how to value those type of assets. So today, when we look at the market, particularly in the U.S., you have the debate around FANG, and some of those names probably are richly valued and too richly valued, but some of those businesses shouldn't trade at a low multiple because they're great businesses. They have good growth prospects going forward. They generate very attractive returns on capital, and they should be able to continue to compound their capital and really compound their intrinsic value and their worth very attractively for years to come. And so it wouldn't be logical to assume that kind of name is going to trade at a low multiple. So for us, by having this intrinsic value mindset, we think we're well kind of situated to kind of navigate whether or not there's these toggles, if you will, in the market between value versus growth. But overall, it still allows us to find kind of attractive opportunities no matter where we are kind of in the market cycle.
From your standpoint, that means sorry for that.
Oh, that's okay. I was just saying, what I think is great is that a lot of times that debate that between value and growth, it can create some volatility and additional volatility into the marketplace, and it does then show the value of having your stable fixed income portfolio to that kind of keeps your portfolio in a more stable place while that plays out, and then you can look for value as you look for good value, good cheap growth in the marketplace. But I think it also creates opportunities on our side from a risk standpoint, is that sometimes that volatility flows into whether it's the emerging markets or into the high yield market in particular, sometimes into the IG market, and creates opportunities for us to add to our risk positions. And it's just a way that the markets work together, and investor sentiment can bleed, because it can occasionally flow in there. Now, like I said, that's why some of the higher risk places, where there's high yield or bank loans or EM, we think about more on a beta to some of the riskier, the stock versus correlations. But I think that discussion is very interesting and relevant to what we see and how that plays out then across the financial markets.
From your standpoint, as someone that is constrained to, well, not constrained, but an important part of what you're doing is really reviewing the cash flows or the future cash flows of bond payments, which are very much projectable, right? I mean, very different to projecting the growth of a company, in which for example, Tesla. Okay, you're basically predicting that the whole country is going to be driving electric, these 60,000 very fancy electric vehicles. That is very hard to predict. I mean, what is your take on that as a fixed income analyst? Do you think that the market is just putting an absurd pricing to these companies, that it's forgetting about the fundamental valuations of the underlying companies, or what is your feeling on the growth situation?
Yeah, I mean, I think there is probably a bit of euphoria around changing dynamics in the economy, and when there's potential big rewards to be had, and you're trying to pick the winners and losers, you tend to select, and some stocks, some companies get very high multiples because people just bid them up just on pure hopes and dreams. However, there is a real dynamic that's shifting in the U.S. economy and global economy as we move towards an electrification, whether it's in automobiles or in some of the other ways we use energy. So there's reality there, and that's why you got to think about it. But there is what are you going to pay for it, and you have to decide who's going to be the winner or loser. And to your point, how do you forecast cash flows in the future in a market that is just developing? That becomes very hard. That becomes very difficult for a fixed income investor to get behind, to say, pick the winner and say, I'm going to give you $100. Are you going to give me $100 back in 10 years? If someone's not cash flowing today, I have no idea. So it's really going to be, it's a very difficult proposition. Plus, in this market today, what you're getting paid to take that risk is very much a fixed income type return. Sometimes in some markets in fixed income, you could say, okay, you're not a cash flowing company. You could buy a convertible bond that has a good coupon and a fairly low strike price, and then you're saying that's value. Or you could buy a high yield bond of that company, and maybe it has a 10 to 15% type coupon on it. And then you could say, I'm maybe getting something that looks like a an equity type return. But that's not the case today. Those are still more in the, we're still talking for companies like that maybe aren't cash flowing, or maybe in the mid to high single digits. And that isn't a bet I want to take. If I'm going to make that bet, I think you are going to go, I would say, let Miguel take it in his portfolio, where the risk reward is, like I mentioned before, we both might get zero, but if it works, and even if it's a higher valuation, you may still make 5, 10, 20 times your money or more, because that's the way the equity market is designed. It's high risk but high reward for making that bet. And I would say let the equity guys dream and hope, and we will take more certainty. So we're looking for more businesses that are well developed, unless there is some, like I said, natural bells and whistles, whether we can get warrants that are attached to it that maybe pay off if the company does well, or like I said, a convertible bond, or there's some other structures that we can get involved in. We have, but far and few between today. A lot of people aren't selling their equity to the fixed income market, or if they do, it's pretty expensive. So I mentioned convertible bonds, with a reasonable coupon and a reasonable premium. Today, convertible bonds in the market for a lot of these stocks that are highly valued on the growth side have zero coupons, which makes sense for them because they don't have a lot of cash flow maybe. And then the premiums are 50%, or higher from current stock price. And that makes for a very expensive fixed income product that just doesn't look attractive when you put it on top of high valuations to us.
Perfect. Last question, because we only have. Oh, sorry for that, Miguel. Go ahead.
So I was just going to make one of the things kind of Lon touched on there is the ability to kind of have confidence that the company is proving out their model, right? And I think one of the advantages that you get from equity manager like Thornburg is that because our portfolios are more concentrated, we do spend more time being able to dig in and analyze and think through the business model in more detail. So, while can't speak to something like Tesla, you can analyze successful e-commerce businesses in the U.S. that do generate attractive cash flows that granted, they reinvest it all in CapEx to continue to grow, but you can have confidence that those businesses are attractive and they do generate cash flows, and at some steady state in the future, they will be very attractive returners. And then you can then take that out and look for similar opportunities in other parts of the U.S. or globally. But I think that's an advantage that comes from being able to be concentrated and to be able to spend more time kind of thinking and analyzing through the holdings or potential holdings that would go into a portfolio like ours.
Of course. One last question and just a quick response here for the audience. Inflation, I know it is a very important subject right now. There's different ideas on inflation, whether it's really going to be an issue or not. But should you be invested in equity or in fixed income to hedge against inflation? And just a quick few words on this, please. Miguel, you can start.
Yeah, I think my view is that it's very uncertain. So since the late 1980s, we've had 4 real instances of relatively low rates and then inflation impacting the markets. So the way we've tried to approach this in our strategy is we want to buy businesses that we think are undervalued irrespective of what's happening with inflation, but that logically the business model should be more protected when inflation does come, or if it does come. So understanding, does it have pricing power? Understanding how kind of its inventory works, et cetera, so it can replenish things at much more favorable prices sooner than other companies, et cetera. So for us, it's much more about understanding the business, liking the business, and then ensuring that it can have some elements of inflation protection if that were to come.
Lon, your take on that?
Yeah, and from the fixed income side, obviously inflation can be a very dicey proposition, but it very much depends on how rates respond, both in terms of out the curve, so how inflation expectations get embedded into longer rates, but then also how central banks react. So one of the biggest things, so to protect kind of out the curve, you can kind of buy inflation protected securities, in the U.S., TIPS. You can buy floating rate securities. Maybe it is a leveraged loan, but maybe it's just a high quality investment bank bond that is 4 or 5 years and it happens to float. And so that can help. And the other thing that does work is very much along the same way Miguel's description of investment is the beneficial. You can buy credit. You can buy some corporate bonds that do have pricing power, and that should see their cash flows grow, and that should lead to credit spreads tightening. Now, we're already pretty tight, but we have seen instances, mostly back in the 90s, and the market has changed some. But if the demand's there, you've seen spreads go 10 to 30 basis points tighter from here, which can offset some of that potential rate movement. So I think there are opportunities, but it does become more difficult to find those, and you have to position the portfolio very mindfully and very carefully for that event.
Perfect.
Okay, so thank you very much, Alejandro. You've done a great job, and of course, our portfolio managers have also answered a lot of questions. There are several questions from the audience, and I would like at least to ask you about one of them, and is your view on the U.S. dollar coming forward. I don't know, the next 6 to 12 months or even a couple of years. What do you think the dollar will do against other main currencies? And what will be, how will you position your portfolios accordingly? And for you, Miguel, an extra question about the proposal of a minimum corporate tax. What do you think that will happen? Do you think it's possible, and how will it affect especially companies like Amazon, Google, Apple in the future? So Miguel, if you can please start, and then we can go back to Lon.
Got it, great. So in terms of the dollar, our strategy is very much bottoms up, so we don't tend to make top-down calls as often, especially in regards to the dollar. I do think when we look at the level of stimulus that's been given and promised going forward, and the amount of such a government debt that needs to be issued, it's likely that the dollar sees some pressure from here, maybe even more so than it's seen so far. I think the way we try to address that is in our kind of U.S. dollar exposed holdings, is understanding what kind of dynamic they have around their business model in terms of to benefit or be impacted by that, and their ability to maybe price any kind of inflation that may come from a weaker dollar going forward. So for us, we're only about slightly half of our portfolio is in the U.S. today. So we think that some of our ex-U.S. names should at least be neutral to benefit from a weaker dollar if that were to come. In terms of the tax and the minimum tax rate, I think it's possible that we do see that come through, and clearly that'll be kind of a headwind. And so I do think that there are certain names in the U.S. where optically they may seem cheap, but I think if we reflect a higher tax rate, then maybe they're not as cheap as we think. And so I think the way we're trying to navigate around that is to ensure that we're buying into businesses that do have pricing power, and that they have services that are very much essential so that they can price through some of that tax impact into their products and services, so that the impact to our earnings at the end of the day will be more neutralized than others who don't have that pricing power.
Thank you very much. Lon, your views?
Yeah, I think near term here, as we see, if we do happen to see the U.S. continue to reflate the economy, as Miguel explained, I think we could see inflation and we could have pressure on real rates, which I think would lead to a pressure on the dollar. And over time, I think the way we would think about it, I mean, in a product like UCITS LTI, it's a U.S. dollar portfolio. That's how we invest. So there's not a lot to do there, but that's investing with a lot of people's dollars. So one for one, maybe it's not so directly impactful. But in something like our product like UCITS Strategic, we can invest in foreign currency bonds. And I think this idea kind of flows with the previous question, or the last question we answered, which is around inflation, is that we can try to invest outside the U.S. in countries that have better, higher real rates, that maybe have the advantage in the currency standpoint, but also in a higher carry vehicle where even if perhaps they're seeing a little bit of inflation, they have higher rates to try to control it already. So I think that you'll see a mix of increasing opportunities external to the U.S. But I think even in the U.S., I think we can still see continued benefits from investing in whether it's behind the consumer who can continue to be strong. We can see good spread movement there, but also in corporations that, as Miguel described, have pricing power, that maybe as they have impacts from some dollar flows that are perhaps weaker, and that we can maybe see some pricing power here in the U.S., but also abroad, that will help the ultimate credit spreads and their proposition and bring down their funding costs. I think we could still see some benefits there. And so I think it'll be a mix of all those answers for something like strategic, UCITS Strategic. But I think we'll be in pretty good shape, because as we on the fixed income side follow similar philosophy from the fundamental bottom up. So we don't position the portfolio from the top down, but we definitely take into consideration what the dollar is doing and how it will impact a company's cash flow or a security's cash flow before we make an investment and decide whether the pricing reflects that appropriately or not. And that helps build a portfolio that is very much aware and positioned for weak dollar or inflation abroad, here or abroad.
All right, thank you very much. Thank you, Miguel. Thank you, Lon. And thank you, Alejandro Lara, not Alejandro de Lara, at the beginning of the program. So sorry about that. I just wanted to mention that we got your last name wrong. But it's been a pleasure to have you. And thank you to our audience also for following us.
Thank you.